Chapter 2. Investing and Financing Decisions and the Balance Sheet. Before we can adequately prepare a balance sheet, we must know what activities caused changes in it. Additionally, we have to know how specific activities affect each balance. Finally, we need to know how the company tracks balance sheet amounts. Part 1. The objective of financial reporting is to provide useful economic information to external users for decision-making and for assessing future cash flows of the company. Part 2. For economic information to be useful, it must be relevant, reliable, comparable, and consistent. Part 3. The elements of our 4 basic financial statements include assets, liabilities, stockholders' equity, revenues, expenses, gains, and losses. The primary characteristics of financial information are relevancy and reliability. To be relevant, financial information must have a predictive value. It must provide the user with feedback, and it must be presented in a timely manner. To be reliable, financial information must be verifiable, represent the underlying facts, and be neutral. The secondary characteristics of economic information are comparability and consistency. Comparability means that we can compare information across companies. Consistency means that the company uses the same accounting rules on measurements from one accounting period to the next. Assets are economic resources that have probable future benefits to the company. Liabilities are probable future sacrifices of economic resources. Stockholders' equity represents the financing provided by the owners of the business. Revenues represent the increase in assets or settlement of liabilities from the ongoing operations of the company in its effort to make a profit. Expenses represent decreases in assets or increases in liabilities from the ongoing operations of the company to make a profit. Gains represent increases in assets or settlements of liabilities that are only peripheral to the operations of the business. Gains are not an integral part of the company's operations. Losses represent decreases in assets or increases in liabilities that are from peripheral activities, not central to the operations of the business. There are 4 basic assumptions that are central to the accounting process. The first is the separate entity assumption. This assumption states that activities of the business can be separated from activities of the owners of that business. The second assumption is the continuity of assumption. In the absence of information to the contrary, we assume that the business will operate into the foreseeable future. The third assumption is the unit of measure assumption. This assumption states that accounting information measures only those transactions that are capable of being measured in monetary terms. In addition to our accounting assumptions, the historical cost principle requires us to record transactions at their cash equivalent cost from the date of transaction between 2 parties in an arm's length exchange. In accounting, we deal with external events. These events involve the exchange of assets and liabilities between the business and one or more other parties. We also deal with internal events. Internal events do not involve an outside party, but directly affect the accounting entity. In the process of accounting, We use accounts to help us organize information about various transactions. These transactions can be both external and internal. Here is a list of balance sheet accounts that are grouped as the assets, liabilities, and stockholders' equity. In this course, we will discuss all of these accounts in detail. These two lists contain typical revenue and expense account titles that we would likely find on the income statement. As with the balance sheet accounts, we will discuss each of these revenue and expense accounts as we move through the course. As accountants, every transaction we deal with affects at least two accounts. As we record the transactions, we must make sure that the accounting equation remains in balance. Most transactions with external parties involved are exchanges where the business entity gives up something and receives something in return. That's the duality of effect notion. The accounting process involves the identification of the accounts affected by a transaction. We must determine whether the accounts are assets, liabilities, or stockholders' equity. After we determine the accounts affected, we must determine the direction of the effect, such as whether the account increased or decreased. Finally, we must make sure the accounting equation remains in balance. Papa John's first transaction is to issue $2,000 of additional common stock to new investors for cash. The two accounts affected were the cash account, an asset, and contributed capital, an equity account. The cash account was increased, as was the contributed capital account. Notice the total assets of $2,000 is equal to total liabilities plus stockholders' equity of $2,000. In the second transaction, Papa John's borrows $6,000 from a local bank, signing a 3-year note. The accounts involved cash, an asset, and notes payable, a liability. Both the cash account and notes payable are increased as a result of this transaction. After recording the transaction, the accounting equation is still in balance. Part 1. In our third transaction, Papa John's purchases $10,000 worth of new equipment for $2,000 cash and signs a 2-year note payable for the remainder. Part 2. 3 accounts were involved in this transaction: the equipment account, an asset, the cash account, an asset, and notes payable, a liability. The equipment account increased by $10,000. The cash account decreased by $2,000, and the notes payable account increased by $8,000. After we record this transaction, the accounting equation is still in balance. Part 1. In our final transaction, Papa John's declares and pays a $3,000 dividend to its shareholders. By now, you should be able to identify and classify the accounts involved and determine the direction of change. Part 2. This transaction causes the cash account, an asset, to decrease, and retained earnings, an equity account, to decrease as well. Now you can see the recording of all of our transactions. On the asset side of the balance sheet, we have cash, investments, equipment, and notes receivable. On the liability side, we have notes payable. Stockholders' equity includes contributed capital and retained earnings. Part 1. During the accounting period, we analyze and record business transactions. The transactions are initially recorded in the journal and then posted or moved to the ledger. Part 2. At the end of each accounting period, it's necessary to adjust certain revenue and expense accounts and their related balance sheet accounts. Part 3. Once the adjustment process is complete, we can prepare a set of financial statements and disseminate those statements to the users. Part 4. Finally, we close all revenues, expenses, gains, and losses to retained earnings so that we can start the accounting process fresh again. We keep track of transactions through the preparation of journal entries and the use of ledger accounts. Throughout this course, we are going to use the T account as a tool to represent a ledger account. T account is merely a shorthand term for the entire ledger account. The T account has a left and a right side. As a convention that we've adopted over the years, we are going to refer to the left side of the T account as the debit side and the right side of the T account as the credit side. The words debit and credit have no specific meaning other than that they represent a left and right side of the ledger account. As a further convention, we are going to agree that a debit to an asset account increases that account, and a credit to the asset account decreases that account. Remember, this is just an agreed-upon procedure. Once we have agreed upon this procedure, the algebra dictates that liabilities and stockholders' equity be increased and decreased on opposite sides of the T account. That is to say, a debit will decrease a liability account or stockholders' equity account, and a credit will increase a liability account or stockholders' equity account. Remember that stockholders' equity is made up of contributed capital and retained earnings. Typical general journal entries might look something like this. It is useful to include a date or some form of reference for each transaction. The debited accounts are written first with the amounts on the left side of the two columns. The credited accounts are written below the debits and are usually indented in a manual system. After the journal entry has been prepared, it is posted or moved to the general ledger. Part 1. Recall our first transaction where Papa John's issued $2,000 of additional common stock to new investors for cash. We first record this transaction in the general journal. We debit or increase the cash account for $2,000 and credit or increase contributed capital for $2,000. Part 2. The beginning balance in the cash account is $6,000. We post our transaction by moving the $2,000 to the debit or left side of the cash account. Part 3. The beginning balance in contributed capital is $1,000. We complete the posting by moving the $2,000 to the credit or right side of the contributed capital account. Part 1. Papa John's borrowed $6,000 from a local bank, signing a 3-year note. We record this entry in the general journal with the debit or increase to the cash account and a credit or increase to the notes payable account. Part 2. We post the entry by placing the $6,000 on the debit or left side of the cash account. Part 3. Next, we post the $6,000 credit to the right side of the notes payable account. We can prepare a balance sheet at any point in time by listing the balances in the asset, liability, and stockholders' equity accounts. Here is the asset section of the balance sheet of Papa John's for the periods ended January 31st, 2007 and December 28th, 2006. At January 31st, 2007, the total assets were $396 million. Here is the liability and stockholders' equity section of the balance sheet for the same periods. Notice that the total liabilities and stockholders' equity at January 31st, 2007 is $396 million. Papa John's balance sheet proves that assets equal liabilities plus stockholders' equity. Part 1. The financial leverage ratio is determined by dividing average total assets by average stockholders' equity. When we are performing ratio analysis, we compute the average amounts by taking the beginning balance, adding the ending balance, and dividing the total by 2. Part 2. In 2006, the financial leverage ratio for Papa John's was 2.37. This ratio tells us how well management is using debt to increase assets of the company and use those assets to earn income. When interpreting the financial leverage ratio, the higher proportion of assets financed by debt, the higher the ratio. Generally, companies with a financial leverage ratio greater than 2.0 have a heavier reliance on debt than equity. On the statement of cash flows, investing activities involve the purchase or sale of long-term productive assets, the lending of monies to others, and receiving principal payments back from those loans. When we purchase a long-term productive asset, it's a cash outflow. When we sell a productive asset, it's a cash inflow. When we loan funds to others, it's a cash outflow. When we receive principal payments on those loans, it's a cash inflow. Financing activities involve borrowing and repaying amounts from financial institutions and the sale or repurchase of the company's stock. In addition, the payment of a cash dividend is classified as a financing activity. When we borrow money from a financial institution, it's a cash inflow. Repaying the principal amount is a cash outflow. When the company sells stock, it's a cash inflow. If the company repurchases its own stock, it's a cash outflow. The payment of cash dividends is always a cash outflow. On your screen is an abbreviated statement of cash flows for the 1 month ended January 31st, 2007. End of Chapter 2.